There's some weird stuff going on. Like I can't even count the amount of times Quinn has said that in her shit this week. That just like there's some weird things happening, like under the surface.
As Tyler mentioned, now we're seeing yields fall through the floor as for the first time we've seen like that real flight to safety. We're kind of in this area where it's a sentiment, it's a deleveraging, it's a de-risking thing. All these kind of play into this broader risk-off environment and wall of worry. There's a lot of correlation between the yen carry trade unwind and large cap tech. The BOJ hiked and Powell was super dovish.
Because markets are global now, you have a move in Japan that has caused repercussions in equity markets across the globe. The vol controllers, policymakers will come in, stifle the FX vol, because credit vol has actually been copacetic. The FX vol can really cause an unwind in actual credit. Going forward, this feels to me just like an FX, little earthquake, not a big earthquake.
All right, welcome back to another Roundup edition of On the Margin, and we now have our permanent rotation, the boys triumvirate, something like that. What's going on, guys? How you doing?
Pretty good. Yeah, thank God we got Mike out of here.
Why don't we have Quinn's little piano in the background this time? Where is he?
What are you up to?
Where in the world is Quinn?
I have a wedding this weekend, so I had to do a little travel. You'll get it next week.
All right, can we get can you play something on that thing next time?
Yeah, I'll open it up for us. Yeah.
Little intro music would be awesome. We got a lot of stuff to go through this week, but before we do, I do need to do a little plug. We talked about it last week, but with this evolution of On the Margin and we taking fully over, we just want to get some input on the show and the direction and what people value. So we have a survey that's live. It'll be in the description, and it would be really appreciated. It takes like 5 minutes, and just to get your input on what you like about On the Margin, who your favorite guests have been, and what do you come for. So fill it out, and it'd be super helpful for us.
Yeah, just don't talk any crap about me.
Don't say any bad things about Tyler. He's a softie. Let's start with what happened with the QRA. So QRA, quarterly refunding announcement from the Treasury. It comes out every quarter. And I have a few charts here I'll show that just break down what we've been seeing. So forecasted versus actual net issuance. This is just showing the total amount of borrowing for the quarter that the Treasury anticipates occurring. So every quarter they come out with what do they plan for that quarter and then a forecast for the next quarter. So what I have here is just looking at this coming quarter, so from July till September, and looking at what was forecasted in the previous quarter and what's actually going to be happening. And despite the constant coupon issuance that's staying steady for the remaining future, we've actually seen a decrease in the bills issuance. And the reason for that is due to actually the quantitative tightening taper that we saw recently. So because the Fed has less to unwind from their balance sheet, the Treasury doesn't have to take up and absorb as much on the bills issuance side. So we actually saw total borrowing come down, and with that, total bill issuance come down as well, because that's basically their exhaust valve.
The TLDR for people that aren't really deep on this stuff is inevitably less supply, more demand, yields come crashing down.
Yeah, exactly. And especially on that long end, like they're keeping the supply steady, and even as well on the bill side is coming lower. But at that same time, this is just showing the composition of how much for each tenor that they're issuing, and it's very bills heavy. And then the last one I want to show is just quarter over quarter. So like I said, they have this coming quarter and then forecasted for the next quarter. And from even those numbers, we're seeing even less issuance, especially on that bill side of things. So what does that all mean in plain speak? It's like Tyler said, the trend is going lower for the amount of issuance required, especially on that bill side right now. And that is constructive for bonds. We've seen them absolutely rally over the past week or so. So that was pretty bullish, I would say. So that's the first half of what we saw. We've also had some interesting economic data prints that have come in that have pretty much rocked markets. This is just looking at ISMs. They came in soft today. Some of them, the manufacturing report came in at the lowest basically since the COVID crash. And before that, lowest since 2008. So some things, ISMs have been really hard to, used as a hard signal over the last couple of years. There's been a lot of false starts, but this is really weighing on markets. The other thing we got was initial jobless claims. And this is really, really tightly correlated and somewhat of a leading indicator of the unemployment rate. And what we're seeing is that's starting to break out and come out above forecast. So when I look at that, knowing that we have this jobs report tomorrow, I'm wondering if we're going to see, an upside surprise in the unemployment rate. So those are the few things that we saw. We obviously had the FOMC meeting. We'll get into that in a minute, but just want to, set the stage there and see what you guys have been looking at.
Well, I was impressed that Powell brought up the SOM rule on the presser this week, incepted by Felix Joven. How do you say your last name? Joven?
Joven. Or the real French way is Joven.
Joven, yeah. You have been up on this, the unemployment rate kind of gradually going up, and this is really what they're looking at. The other thing that I'm really surprised at is the forward break-even inflation has been just precipitously dropping. So add in the fact that you have less treasury supply from the QRA, and then you also have forward inflation just imploding here for probably global reasons. And bond investors love that. So that's why treasury yields have gone lower. Corporate bonds have rallied. Today, we got the first sign of a little bit of credit stress in high yield. We'll see if that follows through, but that's sort of what I'm watching right now.
Yeah, I don't know. You might have said it, Felix, if people know we're recording this Thursday afternoon, right after the close versus our usual Friday time. So we'll be pre-payrolls and everything and coming fresh off the damage of what was today. But yeah, I found it like yesterday's events were about as good as you could ask for from a dovish perspective. Like the QRA, Yellen, they kind of did everything in the realm of plausible deniability of juicing before the election, and Powell did everything he could, but explicitly safe. September is a lock. So, the markets had a very positive reaction. Then this huge down day. Looking at the broader indices, they didn't break below, the previous lows in a big way. And it just seemed, still some indiscriminate selling across the board. There's a lot of things, even the winners were getting thrown out. We saw small caps and everything down despite rates being down, which was a correlation, that was not existing. So it's tough to say here. I do think that, the market seems to be trying to tell the Fed they're behind the curve and what response this elicits from policymakers over the coming weeks. We know it's an election year. We know that this probably is going to be rectified between now and November, but the time it takes is unclear to me. I think the thing I'm thinking about most is coming out of this, what does that look like? And who are the leaders in the market? Because I was in the camp pretty strongly that this wasn't the top in AI. Obviously, price is way lower, so it's easier to make the case that it was now. But actually, why I think that is a little bit less so in the way that the way out of this is either a stronger than expected economy or Fed easing, and it seems it's more likely to be a sooner or bigger Fed liquidity response, which would then weaken the dollar. And we saw what happened when the dollar weakens, which was small caps ripping and tech kind of just treading water or going down. So, we'll see. It's still kind of in diagnosis mode versus
I think you hit a good theme there, though, about what's going on is that looking at yesterday's FOMC meeting, Powell and them are in the camp of normalization cuts. He was pretty clear that he doesn't see a slowdown. He sees an equilibrium in the market and the economy, not necessarily overheating either. But the market, although it was alongside Fed for a while there, it's definitely talking about recession now. When I look at what's going on in the bond market and 10s breaking 4% with nominal GDP above 5, like that's a huge contrast going on right now. So the market's starting to head towards calling out, and markets are forward looking. We'll give them that. So they're starting to look at growth scare to recession. Powell on the camp is still, they may end up being late, maybe not. Maybe they're going to be right, and we might see a rebound again. But they're in normalization mode. So now we're seeing the market and the Fed a bit at odds, and we have this pocket now with no meeting until September. So who's going to be right. I think we're all, like you said, trying to diagnose that. Right?
I don't think recession is really what's pricing in. Credit spreads are out like 15 basis points from all-time lows. Check out slide 18. This is the CDX on high yield, and it was up 13 basis points today from basically low. So the credit markets aren't saying recession at all. It's a little bit weaker, but what I do think, what Quinn said before, is the Fed might be behind the eight ball in easing. Check out slide 20. This is the 2-year forward break even versus the 2-year nominal. The 2-year nominal is the white line, and the forward break even is 1.70. And then the ratio between the two is on the bottom. So basically, you're looking at this. The higher the ratio it is the less the tighter financial conditions are. So the inflation expectations are falling faster than nominal yields right now, which means things are actually tighter than you think they are. So you're getting more of a real yield. The bottom ratio is the real yield.
Yeah, so, even though Fed funds have stayed flat for a year, we've been getting tighter, basically.
Yeah, exactly. So, and you're seeing this, the inflation expectations are dropping precipitously, and nominals are still kind of relatively staying high. So we need the Fed to ease way faster for things to get better. And then on top of that, one other thing that I'm looking at is the TLT to HYG ratio, which is slide 19. This ratio is the TLT is the 20-year treasury bond versus the HYG, which is a high yield bond index. And this ratio has been falling since the middle of COVID. And that kind of says you had peak credit stress. You see when that orange line dips really hard and credit markets were basically unraveling on the high yield side. And now the low was made in credit stress like mid 2024. Sorry, the low was made in the ratio in mid 2024. And now TLT is getting a little bit stronger relative to HYG, which basically means people are fleeing for safety. They're going to treasuries rather than high yield. And this is going to be important to watch in the next couple of weeks to a month to see if the credit cycle is really starting again, or there's a problem somewhere in the credit markets. I think we're probably more on the side of the credit cycle might be starting again. If you look at charts of, HYG and LQD, there's only been inflows. Now go to, this is fascinating. Go to slide 16. In light of all this, this is high yield inflows. You remember we talked about this last week. Mm-hmm. 0.6 billion in inflows a couple weeks ago, 1.5 last week. There's 425 million in inflows in high yield in the face of all this crazy equity stuff going on. So this equity action, I think, is largely just it's a market structure issue that I keep screaming about. It's passive and systematic and quantitative investors that all have these algorithms that mimic one another, and it creates these crazy drawdowns. Now, to give you a sense of these drawdowns, check out slide 22. This has been a 10% drawdown with almost zero credit stress. This is how messed up the equity market structure is. And Mike Green talks about this pretty well, but 10% drawdown, this is how drastic it's been, how fast it's been. And to me, I saw the VIX invert, which is the front one VIX over the 3-month VIX today. And I usually buy those because it's one of the most reliable contraindicators in terms of short term. When that happens, you usually get a rip your face off rally next. So I'm waiting for that to happen. We'll see if that happens after the jobs number tomorrow. But largely, I'd say credit's not really a big issue. Recession, I don't think we're too early for that, especially after Meta reported. I just think that's a cool thing to say to sound cool. Oh, there's going to be a recession. Let's, get some headlines. I think we're so far from that. However, there's real problems in the equity market structure based on how it's set up. It's so messed up. Mm-hmm. It's systematic communism. And this is what you get. You get these massive drawdowns. And we've talked about, I'll stop after this, but implied correlations. check out the implied correlations. This is slide 21. And I'm not going to like say I told you so, but we watched this fall to 8.
Yeah, we
You can
talked
go
through the
back.
downtick, and
I almost nailed the top in large cap tech because all this dispersion trade was just so obviously stretched. And now we're getting a reaction. So implied correlations are going up now. They're at 17.66. It was at 8 before, which was just like a sign of kind of a blow off top. And now correlations are rising. We'll see. I bet it gets rejected here because after earnings, the buyback machine turns back on. But there's definitely something funky in the quantitative systematic market structure that causes this stuff to happen. And it has nothing to do with value, like how these things trade. It's just herd mentality on steroids. So you have an opportunity. Do you buy it or not? Like these drawdowns are going to get more vicious because the market structure is so screwed up. But I think this one you buy because there's not much credit stress. So that's where I'll stop.
Yeah, I think you really nailed the theme that I've been hearing from some people. It's just there's some weird stuff going on. Like I can't even count the amount of times Quinn has said that in her shit this week. That just like there's some weird things happening. Like under the surface. I mean, what do you been seeing, Quinn, on your side?
One of the big signals that's different from this sell-off from previous is if you look back to April 24, October 23, March 23, October 22, all those big sell-offs we had before this, yields were rising, and long-term bonds provided a poor hedge. If you think that 60-40 portfolio, everything was going together. As Tyler mentioned, now we're seeing yields fall through the floor as for the first time we've seen like that real flight to safety. The dollar's been bid. But I think the last number of months where we've talked about this, where people have been equating or conflating, NVIDIA and AI with the stock market and the economy, just because both have been resilient. It's been easy to say the U.S. has outperformed the economy strength and stock market strength, the rest of the world. And how many times do we hear people talk about the 493 versus the Mag 7 and that dispersion? And we're seeing that unwind. And so that's what makes it tough about picking a bottom here, because that unwind could still keep occurring. You have to pick your spot where you think fair value is. And then, like I said earlier, what do you buy on the other end of it? Because this unwind doesn't necessarily mean the leaders coming out of this is tech. So I think we're going back to this emphasis on the markets not being the economy. We got so stretched from financial assets being, speculative financial assets being stretched from, I would say, economy-based financial assets like commodities and cyclicals and things, small caps. And so that's reverting. And we're kind of in this area where it's a sentiment, it's a deleveraging, it's a de-risking thing. It doesn't help that we have serious geopolitical things popping off in the Middle East again, and in South America again, and election uncertainty with Trump versus Kamala. So all these kind of play into this broader risk-off environment and wall of worry. The first is that linkage between the NASDAQ in orange there and the yen in blue. So there's a lot of correlation between the yen carry trade unwind and big large cap tech, and we've seen the yen continue to strengthen against the dollar. The BOJ hiked and Powell was super dovish, so kind of corresponds to what we summarize from it. So maybe to the point, this unwinding of this overpowering tech is finished here. Maybe we're trying to put in a bottom. On the next two, going into Fed rate cut expectations, it's quite dramatic. So you're looking at, we're up to 25% chance of a 50 basis point cut in September.
Yeah,
and
that's wild to me.
Yeah, and so that's this Fed behind the ball narrative. NFP tomorrow is huge for that, because if it comes in weak, then that really speeds up this Fed is behind the ball narrative, and you probably see that 25% chance, go
Yeah.
30-40%, and the market I don't think would respond well. But that's a lot of cuts.
Yeah, just to talk quickly on the NFP thing, I think, obviously we're recording this before that comes in, but yeah, if it comes in, if the unemployment rate comes in, I don't know, a few ticks above where it is right now, so calling back to the SOM rule, which Powell was asked about yesterday, that could well trigger it tomorrow. We're really, really, really close to it. And what that does to the markets, what that does to expectations, like that could do something very interesting if we get that SOM rule triggered tomorrow. So, we can follow up and see if that actually transpires. But to your point, I think that could be one of those ones where bad news is bad news instead of bad news is good news.
So these rate cut expectations of the Fed, I think, summarize this market view. And the other thing I'll be watching tomorrow with that is what assets have relative strength, because presumably if rate hike odds continue to shoot up, yes, it's on the back of weaker economic data, so that's bad for the small caps in the economy, but they also are the biggest beneficiaries coming out on the other side of it. So just maybe the other quick ones I can run through is on the yield curve. So I put a chart here that shows the different yields in the 3-month, which is obviously short duration, is at 5.1. So basically pricing in what we talked about of guaranteed 25 in September and potential for 50. But then you have the 30-year down to 4.3, the 10-year dip below 4. I mean, these are like taking the 10-year below 4 is basically 6 25 basis point cuts, more than 6, right, over the next couple of years. We're starting to get into rich territory on bonds, in my opinion. The next one is the 2-year minus the 3-month. You can see we're kind of down to inversion levels close to, banking crisis 23, early 24 in terms of cutting expectations. And then on the last two is the 210 and the 10s 30s, which just shows, as these near-term rate expectations are falling drastically, we're seeing a much lighter decline in long end interest rates and bond yields. So that's why we're seeing the yield curve steepening, because market participants are anticipating Fed action here, which should stimulate the economy and ultimately at some point reignite inflation again and growth, and that's all else equal, makes long bond yields go up. So pretty interesting time. Like I said, I don't have any great definitive views to take at this stage, but these are the things kind of in real time that we're watching.
Yeah, I think the bottom line of what we're seeing here is because markets are global now. You have a move in Japan that has caused repercussions in equity markets across the globe. And I think you need to stifle, the vol controllers, the policymakers will come in, stifle the FX vol, because credit vol has actually been copacetic. The FX vol can really cause an unwind in actual credit. When you see the Japanese investors, who are the largest yield investors in the world, if they start taking money out of our bond market, there's a sign something's wrong somewhere. So far, we haven't seen that. That's something we need to pay attention to. But going forward, this feels to me just like an FX, little earthquake, not a big earthquake. Something big.
I mean, we can't discount the fact that, the Bank of Japan hiked rates above zero for the first time since I don't know how long. Within this modern market regime, we have not been in this area now. And that has cascading effects, like Quinn showed in that chart of dollar yen to Qs, right? So, at the same time, they're also talking about stopping buying JGBs as well. So we'll see how long that will actually be able to hold on to that. But the fact is they're trying, and that causes stress. So, tying back to what we talked about last week, that has impact. Currencies are always pair trades. So if we're looking at dollar yen, how does that resolve itself? Obviously, we hit like 150 on dollar yen recently, but that also is tied to what the Fed is doing at the same time as well. If we're getting accelerated cuts that were not priced in at all recently, we're at like 3 cuts priced in by the rest of the year. That will also have effects on these cascading currencies as well, for sure.
Yeah, the yen moved 8% in like a couple weeks. Think about how much that is. If you're an exporter, a Japanese exporter, like that's a big move. And then all your pricing gets messed up. So it makes sense. Herein lies the problem with globalization.
Yeah, it's insane to think about, like that we're used to, I don't know, equities or even like cryptocurrencies where it's like, oh, it moves 8% every day, but this is a currency and it's one of the world's biggest currencies. Like
Yeah.
these moves are not normal.
Yeah.
Yeah,
So-
like Nvidia's like daily market cap move the last few days has been the size of Bitcoin's like total market cap. It's like these numbers kind of stop making sense.
Yeah. On that point, I mean, this is a chart I'm just looking at right now. I've been watching Nvidia 1 month implied volatility rolling, and if you just go back over time, it looks pretty extreme here in terms of implied vol has just spiked. It went from 40 last month to 80 now. So I don't know. I'm a seller of that usually after earnings. We'll see if the equity market comes down.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Yeah, I mean, that's a nightmare to just think about, like the market makers on the other side hedging that. Like no one ever just seen these like huge gamma swings. Like I think Nvidia was up 13% yesterday, and now we're down. I don't know where we closed off, but last I saw it was at least 8% down. Like 6.67% down on the day. Like those are huge moves that are gamma focused. Maybe we can switch gears here and talk about what's been going on in crypto, because it just feels like it's just been, hit a brick wall every time, like that there's possibly a chance for it to break out. Like equities were just soaring for the past month, but we had to deal with Germany selling, we had to deal with Mt. Gox stuff. And then as soon as those clear up, equities start to roll over and weird stuff starts happening, and it's starting to get clipped too. What are you guys seeing on the crypto side of things? I know, Tyler, you had an interesting tweet about what's been going on with Bitcoin.
Everything macro was telling me that Bitcoin was about to blow off through 70K. You had the dollar coming down, global liquidity going up, global collateral was rising, bonds were rising. So you had all the setup for Bitcoin to break out through 70K. And the fact that it didn't felt really manipulated to me. And so I was, this whole overhang of the 2 billion in the US government was fishy. And I don't know if that's a political thing or not. I don't even know if they're selling, but it appears someone was selling, whether it was Mt. Gox or the US or whoever, someone wanted to stifle it, who was a larger holder. And, therein lies the risk to markets. But judging just from a macro perspective, everything set up pretty well, and it did not react to the Fed's presser, which was pretty bullish, and almost every asset went up yesterday. So there's very funky things going on in markets. We'll see if it settles out higher. I think it should be acting more like gold here, but c'est la vie, you got to learn.
I think the government coin movement plus there's Genesis, Gox, etc. We've known about a lot of these supply headwinds. That's putting a damper on just people's like probably animal spirits to go super long and levered. But after today, I kind of reassess that maybe Bitcoin yesterday was the canary in the coal mine. I kind of believe it tends to usually bottoms before other risk, and it usually peaks out before other risk. So maybe it was sniffing out something that wasn't quite right it'll be interesting to see how over the next few months it let's say trades back in line with the Nasdaq. If you look at the correlation chart, it's been now for almost 2 months, I believe, pretty negatively correlated with the Nasdaq, and that just doesn't exist in perpetuity for that long. Normally, it's actually really good buying opportunities when the correlation becomes so stretched negatively like it is today. So I think it's more of a patience thing. Like it kind of happens where everybody gets super excited at the top and the peaks, and we saw one coinciding with the Trump speech and tons of leverage added. And when everybody's watching the chart, it doesn't happen, and it's usually on things that are surprises or unexpected. So I think it's more of the range until. Although I've just noticed as we recording this, Saylor just announced, MicroStrategy's announced a $2 billion shelf offering. So that's going to absolutely crush MSTR, but Bitcoin's mooning on it.
Coinbase just beat earnings on the top line. It's trading up, let's see, just small in the aftermarket.
Yeah, 1.5%.
Yeah.
King Saylor, that's unreal. The market's gonna love him. He's basically saying, "Here, I'll offset those government sales."
Yeah, I mean, like we're seeing this live right now come in these Coinbase earnings, but transaction revenue climbed to 780 million in the second quarter, which compared to 327 million a year ago. That's pretty impressive. I think Coinbase, like, it's a good play. It's a really good pulse on where things are headed. But yeah, I mean, just tying back to one thing that you mentioned there, Quinn, about a lot of crypto has been tied to, it's become a bit of like a Trump trade now. I saw a funny tweet from Nick Carter yesterday who mentioned that in hindsight, turning Bitcoin into a Trump win market may have been a mistake because there's been this shuffling in basically the odds market as the Democrats have finally got their shit together and have pulled together a little bit, at least have a contender. That's shifted odds a bit. And we've been seeing this like Trump trade index come lower as his odds have been coming a little bit. So I don't know if you guys have been looking at that same way. I know you're trying to chart like Sol BTC to Trump odds, Quinn, or something like that.
Yeah, I just think it'd be interesting to see like this whole resurgence and the momentum behind Kamala is interesting. Like I think it's going through most markets, but I do question how much the Trump bump. I'm kind of a fader of like that really being a key monumental driver thus far for markets. And I also think there's an interesting discrepancy between, let's say, media headline momentum and actual people betting on the outcome momentum. So more of the story is like anybody had a better chance than Biden, in this position. So this reverberation or honeymoon phase was bound to happen. And you have a pretty clear, event on the horizon of the DNC that very well could mark, a peak at least temporarily or locally. So I think a lot of people are looking out to that as like that takes the foot off the crypto brakes a little bit going into mid to late August. But it's definitely having an effect, right? I mean, I've seen in many macro and traditional research articles, headlines, Bitcoin and crypto tied to this Trump trade and people saying it is the best way to speculate on his victory. So if that swings the other way, right, you're going to obviously see people retract on their buying ambitions. And we've seen it. So, but again, it's like, we're just in this range, right? It reminds me so much of like a 2019, 2023 summertime period where, we're in a trend change in the economy. We're on the precipice of a new liquidity cycle. Things are, unemployment rate going up today is not quite the same as is it going up in other economic regimes, right? Because part of that is a supply thing versus just purely job loss thing. So I think on a medium term, with November on the horizon and a potential regulatory shift, you still have to be very medium term optimistic and just not get so chopped up on these moves. Because when you zoom out, you're like, wow, we've just stayed in this range and it's been, it's getting boring. I feel like the time to really hammer it is when it gets even more boring than it is now, and like more apathetic. And when you're like, you're telling yourself like, all right, I should have just listened to these guys. I should have listened to log off and go to the beach. Everyone that was saying that in May or June, that's when you're about to throw in the towel is probably when you should go like max long. So I don't know. Let's just be patient. And
Yeah, it feels a lot like how it's been like last summer, and I think you also compared it to like summer 2019 too. Like just the crypto market's pretty small, and if you just on the margin take out a few people to go off to the beach and stuff, like you start to just get these whipsaw moves. Like we were almost at 70K the other day, and open interest just absolutely exploded. Degens piled on, and then the whole thing just reversed as quickly. It's not easy in the summer.
Not at all. I think August was notorious. August 1st also is notorious for one of the worst days historically, I believe. So
I can see that. I can see that for sure. Did you guys see these Tether earnings that came out this week? It's an absolute behemoth, like insane. It had $5.2 billion in profit. And, it felt like just a few years ago is when everybody was wondering if Tether was a huge Ponzi scheme. And you don't really hear much from the Tether truthers anymore.
Yeah.
I mean, and along with that, they own $97 billion in US treasuries now. And a lot of that is T-bills. Like they're the biggest marginal buyer of treasuries these days. That's wild to me.
To me, that's incredible. This is why crypto should be bipartisan.
Mm-hmm.
It doesn't matter. I think the left will come around eventually, but the fact that they haven't makes me very skeptical because they need to finance deficits. And if you have this big buyer of treasuries, that like you want crypto to work. It sits right next to the dollar. So you have the ability to spend more money if you have an incremental new buyer. You're basically subsidizing if global investors are buying Tether and then Tether's buying, US treasuries, you're lowering your cost of capital. So this should be a home run, especially if you subscribe to the left likes to spend money more, even though the right spends, just as much money now because it's a giant Ponzi scheme. You should be wanting crypto for this very reason. So I mean, it's incredible that they're doing that well. I wasn't expecting that.
Yeah, I know. It feels like it's slowly heading in that direction and people are starting to get it. I mean, it's a win. It strengthens the dollar's hegemony. Like,
Mm-hmm.
and I think most people get it. Like I remember there was a FOMC report a few years ago from I think Randall Quarles, when I forget which position he had, but he wrote a letter, basically an editorial piece, talking about stablecoins and his view on CBDCs. And his view was that I see no reason to create a CBDC. Let's let the private market do it, and let's like he started talking about stablecoins and how they're U.S. denominated, and compared it to a U.S. money market fund. And that was where his head was at. So I imagine there's a lot more people in the Federal Reserve that think that way. They just don't explicitly say it. Republicans are getting more comfortable with saying these things. We've had like Paul Ryan come out and explicitly say it. It's now becoming a key platform from the Trump side of things and really actively discussing it. Feels like the Dems are slowly getting there, but they're sort of the last ones to that party of at least explicitly realizing it.
Well, I think if you go to the decentralization versus centralization battle, the left likes centralized power. And, the giant tech companies are largely a lot of their financing in one way or another. So in the tech companies, the large cap tech companies do not want Bitcoin to win because it's orthogonal to their incentives. They don't want things on the blockchain and decentralized. So I think that's the game that's really going on here on the left, which is like your donors are saying, no, you can't get behind that because like that kills our business model long term. But the funny thing is the large cap tech companies are going to be taxed to oblivion in California as is because all the rest of the companies are moving here. So I think long term, it's Bitcoin's going to win out regardless. But yeah, I think it's a big battle of centralization versus decentralization mostly.
What do you guys think about the theory that, we've had these ETFs come in and instead of trying to outright stop Bitcoin or stop crypto, let's just pull it into the system and basically disintermediate people from their keys, where, buy Bitcoin as in like BlackRock approved Bitcoin. And, this has been sort of the argument Jim Bianco's been having, your favorite guy, Quinn. But maybe start with you. Like, do you think that's the approach then instead, or is it not as conspiratorial?
I'll take this one because I am like a skeptic on this. Larry Fink being the first one that like really nudged this on the regulatory side. He's a very political animal. And yes, it does worry me that happens. However, big markets need big liquid players to buy if you want to grow. So part of me also thinks that like that's the natural evolution of these things. What's annoying is like Bitcoin gets caught in these quantitative drawdowns and it gets correlated with everything else. Therein lies the centralization problem. That's what drives me nuts about it. It used to be, hopefully it gets uncorrelated like gold. Gold's not in a lot of that stuff. So I hope it inevitably gets to that point, but we will see.
A take I have actually on this political topic is one on like the reserve. A Bitcoin reserve is one, aside from like a little working capital stack to make people feel good. Like, the U.S. is one of the largest owners of gold in the world for obvious, historical reasons. The dollar was tied to gold and that sort of thing. So that's more of like a holdover from previous policy. It doesn't make sense to like be a long-term accumulator of Bitcoin if you're the U.S. government. I mean, strategic front, it's inflationary. It's inflationary for your currency. It's the same reason why if you're, Apple or some corporate public company, you don't sell your stock to buy a competitor's stock. At the end of the day, like there's a wealth effect if they were to pump the price of Bitcoin. That's inflationary. You're debasing your currency by printing more. Like, I get why there's like maybe pushback on some of like the BTC Maxi. Like, it's kind of like the stuff you hear in the ecosystem, like the tribalism, right? Like, if you're not all in, you're against us. And it's like, yo, I have a lot of exposure to this asset class and I am an open-minded person. That's what got me here in the first place, right? I'm open to new kinds of technology and forms of money. And so I think it just like that cooling of cooler heads prevail typically, where, don't need to be so one side about things. Like the government can embrace so many aspects of crypto and improve regulation, updating 1930s securities laws for things like the internet, right? I mean, so without necessarily having to like pump Bitcoin Maxis bags and things. So I see both sides, but yeah, I mean, obviously there's been a huge tyranny against the industry, and the whole stablecoin thing is the most obvious, by far the most like undebatable. Like, it's impossible to make a case against it. You get everything the government wants to do: print more money, finance bigger deficits, monitor people's transactions and economic activity, control the flow of capital. It's all right there. Like, they should be sprinting hand over fist for stablecoins.
Yeah, well said. Just want to wrap up with our meme of the week here. I don't know if you guys have been watching the Olympics, but been seeing these going around of the shooting one. And this dude on the right, he's from Turkey. And, all these shooters are, with their pistols had all this like, complex headwear, whatever, to do various things. And he just showed up with none of it, both eyes open, and he got a silver medal, which is so sick. Like, he's from Turkey. He just looks like a dad who's just like, I'm going to pull up to the Olympics real quick. And I think like maybe we could change technical analysis trader to like quant traders, or, like market neutral pod shops versus Chad buy and hold, because all these pod shops are just blowing up right now, left side, right, and center. But if you're just riding beta, you're chilling, and it's awesome.
Be the guy on the right for sure.
Dude, there's a lot of content coming out of the Olympics, man. Holy, like, what a machine! The French are giving social media a real bank of content.
Yeah, as somebody who's half French, I'll apologize on behalf for any sort of those.
Is there really a tie there? You don't like if you're Montreal, you're not really like. Are you super French?
Well, my
I mean,
dad's half Montreal, half France. So like I
okay,
have family in France. So there's a little mix. But
okay,
yeah,
gotcha.
that is valid. You know,
I
people
didn't
from
know if there
France would
was like
say
a
you're not.
claim where everyone's really like they're cheering for France rather than Canada in Montreal or.
No, I mean, if you go
It's
to France, they don't even think you're real French if you're from Quebec. So that's
Yeah,
what that
that's
is.
what I thought.
the Olympics need to go back. Like there needs to be just a retraction back to like the original purpose and sport. I mean, let's just go back to like weightlifting, running. I mean, I just walked past the TV. There's 3-on-3 basketball. I'm like,
Yeah, what was
what
that?
is
Yeah.
this? Just participate? What like? No chance these guys are even like top 100 players in the world. Why are they even playing? There's men punching women in the face. There's people swimming in a sewer water and puking. What is going on? This is the showcase of the world's best athletes. Like,
Okay,
what is this?
I need to rant on this because I've been studying a lot of political philosophy lately, and there's this guy Michael Millerman. I've been taking political philosophy lessons on, and he's an expert in this Russian philosopher named Alexander Dugin. And what Alexander Dugin says is liberalism, once it beat communism and fascism, it starts eating itself. It's like a snake eating its own tail. And we're literally, I think this guy is so spot on. He wrote a bunch of books, but it's now eating itself where everything that's not on the right, everything on the right from the left's point of view is fascist. Everything on the left, on the right's point of view, is communist. So it's not working. So you need to have a new framework of how society works. And you can just tell by looking at the Olympics, this shit ain't working no more. We need a new social contract, a new political contract to go from. And
hopefully not just a new enemy, because that wouldn't be ideal. But I like the idea of a new social contract instead.
Yeah, and so he has this idea. It's called the fourth political theory. That's a little bit different, and people people think it's very conservative and it's Russian, but I think it actually works a lot better than what we have right now, because it's just what we have right now is just eating itself, and you can see it in institutions. Everything's failing. Everyone's trust is just like down the tubes. I don't know. Sorry for ranting on this, but it's really important that we get this contract rewritten.
Yeah, it's a good one. I mean, I think a lot about, people have talked about this idea of like horseshoe theory in politics, where when you go so far left or so far right, they kind of start to be in the same point. And I think about that, and I think about an Ouroboros like kind of eating itself, and I see the metaphors totally.
Absolutely. And we'll figure it out eventually. I just hope it doesn't have to come to war, but it feels like that might actually happen if we have some crazy event.
Well, guys, that was a great one.
Ending on a rosy note.
Ending on a rosy note. Yeah. Fourth turning stuff, as you say.
All right, fellas. Have a good weekend.
Thanks again. Have a good wedding, Quinn.
See you next week.